Well, big changes could cool Canada's housing market. This week's rate hike is just the beginning because the government is also poised to tighten lending. Now, that could all affect sellers, buyers, and even renters. And to talk about that, joining us in Vancouver is Jasmean Toor. She's the Vice President of Edgar Developments. And in studio with me are Samantha Brookes, CEO of Mortgages of Canada and a contributor with the Huffington Post, and John Pasalis, President of Realosophy, a real estate company in Toronto. He also writes about housing trends at movesmartly.com. I appreciate that there's an adverb in your website name. So, Samantha, I want to begin with the rate hike that we saw this past week. So 25 basis points, small, but described as also being significant.
It's significant because the government has made many moves over the last 7 months. So those moves are playing with the consumer's mindset. So obviously it's affecting their psychological thinking when it comes to purchasing a home. It's not really having that much of an impact because 25 basis points really isn't much. It may run you anywhere from like $25 to $90. In the grand scheme of things, it's really not that much money, but that's really what's happening there.
Not what's happening quite yet, but perhaps even the first step in more rate hikes, because this seems to be a suggestion. In fact, Jasmean, as we bring you into the conversation, there is a question of what happens next if rates go up even higher, because there's a suggestion that might happen as early as this autumn.
Yeah, I think that in the short term, like Samantha said, 25 basis points is not going to affect everyone. But I think that if the rate hike happens too fast, I can see consumers getting into a bit of a panic. I think slow and steady is the best way for the Bank of Canada to approach this right now.
Well,
just because after 7 years of not having any hike, everyone's really used to having, very, very low interest rates. So definitely slow and steady is what I would hope that the Bank of Canada is going to do.
Okay, so
and that's what they said they want to do.
Well, slow and steady is what you're suggesting, or at least hoping here. But I do want to take a look at what's actually happening in a couple of the markets, and particularly the two hottest housing markets in the country. We're talking about Toronto and Vancouver. Take a look at this one. We're talking about Toronto, where sales are down some 37%, but prices keep going up. Take a look. The average price of a detached home in the GTA is just over $1 million. That's up almost 8% from 2016. Condos are $500,000. That's up 23%. So, Paul, what's going on here? Because on the one hand, you see the number of sales dropping, but valuations still go up.
Yeah, so, it's a little bit confusing, I think, for a lot of buyers. The valuations are still up when we compare year over year, which was those numbers are. So they're comparing average sale prices in June of 2017 to June of 2016. But when we look at the average price of a home compared to, say, 3 or 4 months ago, they're actually down. So the average price in the GTA in April was around $920,000, and in June it was around $790,000. So prices are actually down about 14% from the peak, but they're still up over last year.
Okay, and let's take a look at Vancouver now, because this is the comparable board that we actually have from Vancouver. Take a look at this, because detached homes in Vancouver, the average price there is $1.5 million. That's up 1.4% year over year. Condos are $670,000. That's 17.6% year over year. So, Jasmean, what's happening in Vancouver right now?
Well, so I wouldn't even say this is right now. This has been happening in Vancouver for years. We have a really tight housing market. There isn't enough supply to meet demand. So, and everyone needs a place to live. East Side homes are 1.6 million. West Side homes are roughly 3.4 million. Everyone needs a place to live, and we just don't have enough housing to meet the influx of people that are moving to the city.
Now, we also know that as we take a look at these prices and take a look at the demand, that we're also expecting regulators to tighten up the lending rules this fall, because the Office of the Superintendent of Financial Institutions, they're announcing this new stress test, an additional 2% based on what people can afford. Samantha, how is that different from what is being tested right now? How is that going to affect what we see in the housing market?
Well, back in October, when the stress test was originally implemented for the A-side business, it was only, it went up to 4.64. That was the actual stress test rate that was implemented. And if they add that 2% on top of what it is now, then that takes out the alternative buyers or people who are self-employed. And where that's a concern is that people who are self-employed don't necessarily have bad credit, and therefore they shouldn't be placed into that category. So that also takes them out of the market too as well, because not everyone reports all their income on their notice of assessments. And so if that income isn't there, then it's difficult to purchase.
Mm-hmm. Well, let's jump in there just to explain, though, because when we're talking about a stress test, essentially what they're doing is instead of figuring out what the payment would be at the interest rate that is actually being applied, they are testing you on a higher interest rate. In this case, it would be a 2% above the 4 point whatever percent, so about 6% that you're being tested on. And is that unrealistic to be testing people against that level?
Absolutely. I mean, CMHC is not involved in the alternative market, so they don't really need to be. The government doesn't really need to be involved when it comes to adding that additional stress test to those who are not insured under the CMHC rules. So it doesn't make any sense.
What do you think, John? How does that affect the markets?
Yeah, I mean, it would have a huge impact. I mean, I don't know if I entirely agree. I mean, I think it is prudent. I mean, I think it's great what the government did in the fall, which was ensure that buyers can afford their mortgages at 4.65% versus the 2.5% that they were getting. And that's really what the stress test would be now. It actually wouldn't be 6%. It would be if you're getting a mortgage, say, for 2.7%, you'd have to be able to afford if it was 4.7%. I mean, the issue now is, I mean, they should have done that probably 5 or 6 years ago. It would be a disaster if they did it in the fall, because it'd be like increasing interest rates by 2% overnight. So, I mean, the prudent way to do it would probably be to phase it in over probably 4 years. Mm-hmm. But overall, I mean, I think it's a good approach to say, listen, you have to be able to afford it at this higher rate. You shouldn't be buying at your maximum, assuming rates are going to stay at 2.6% forever.
Well, if the government needs to do it slowly, and you use the word prudently, I wonder then, does that mean to say that we are right now in a housing bubble then? What do you think, Samantha?
There's definitely deflation happening right now. The market has come down. It's not at a standstill. People are still buying. There is negotiating room. So I would say that we are definitely seeing signs of the bubble.
We're seeing signs of the bubble because we're now seeing some deflation.
Well, yeah, we're in a bubble.
So, I mean, I'd say we were in a bubble. Like, you know, up to March and April, when prices went up 33% a year, that was, you know, an irrational market. Now, we're kind of in this post-bubble phase when prices are falling. You know, for prices to be down 14% in the span of 3 months is not minor, it's pretty significant. So now the market's adjusting, people's psychology is very different. So now we're in this kind of post-bubble period where prices are softening.
Mm-hmm. And what do you think, Jasmean?
Personally, I'm going to speak to the Vancouver market, but I don't think that we have a housing bubble. I mean, I've been in the industry for over 10 years, and I've been hearing about this bubble ever since. And actually, one of my old coworkers in 2010 commented that he didn't want to buy a place to live because he was worried about the housing bubble bursting. And now it's 7 years later, and I don't know if he ended up getting into the market, but I mean, if he didn't, he would be regretting it because prices are just rising.
No, well, I have to say to that point, Jasmean, I moved from Vancouver in 2003, and at the time, people were telling me, oh, don't buy. It's 2003 because we're in a bubble. That said, what is the advice, best advice? You know, people will have to seek their own financial advice on this, but for the purposes of our discussion, to each one of you, how should people proceed if they want to buy a house or if they want to essentially renegotiate their mortgage?
If people are buying in this market, then they have to know that they have to hold on for a longer period of time. It's not buy today, sell in a year or two. Those days are gone right now, as we can see. The best thing to do is to hold it for at least 4 to 5 years, even longer. If you plan to hold it for at least 10 years, then you know you're in a good situation. But if you try to flip it off now, you may be taking a loss.
John?
Yeah, I mean, I completely agree. You want to buy for the long term. And if you're buying in a softening market, I think the key thing to know is, you know, there is some truth to this idea that, you know, it's a good time to buy when everyone else is afraid to buy and when the market's cooling. But it's also a riskier time to buy. So you got to be very careful what you're buying. There's some parts in the GTA that have like, 10 months of inventory, which usually is a sign that prices are going to fall a lot further. So you need to be very careful. There's a lot of parts in the city that are relatively safe and some that are just going to see probably steep price declines.
So whatever city you live in, you have to do your market research.
Absolutely.
Just to add to that, I mean, those areas are really highly priced when we look at those areas. I mean, we're looking at Richmond Hill, Vaughan, and Markham. I don't think there's any property there that's under $1 million anyways. And so when you look at that market, it has to readjust.
Mm-hmm. And Jasmean, what advice would you give to someone who's looking to either get into the market or renegotiate their mortgage?
Well, I would say for getting into the market in Vancouver, start small because it's very unlikely that you're going to be able to afford a house or even a townhouse for that matter. So I would say start with a condo. Perhaps you can borrow money from your parents and get that really large down payment that's required here. And with respect to renewing your mortgage, I mean, I would just say to do that as soon as possible.